Okay, so hey guys, what's up? And today I'm gonna talk about this particular thing that is called value at risk, or just basically, the maximum risk that you own at any given moment when you take an intraday trade. So I'm gonna make a demo portfolio and then show you a bunch of things. But again, do consider that I personally have not traded for a long time in US options, so I don't exactly know how this is going to go. I'm just gonna go talk about the more um, broad things. Okay, I'm not trying to actually explain you, but I'm just trying to tell you how I'm backtesting it, what my philosophy is, what kind of backtests generally makes sense for me, and what I'm gonna apply, so that you get like a decent idea. Okay, because these same philosophies are also applicable on Indian markets. Okay, so it's nothing crazy. So you would see a small demo portfolio on your screen. This demo portfolio is made with $100,000. I think it has about five strategies, and it has a mixture of the way it has strategies. Okay, and it has been tested on somewhat like, I would say, 2022 to 2025. So I think you guys can see it now. One more thing, it has a withdrawn type as none, and it does not have compounding. So if it had compounding, it would show like crazy amounts of returns, but it doesn't. It's non compounded. But I'm going to explain a certain thing to you, which I believe you should understand while making a portfolio. Okay. So before actually talking about this, I was trying to watch like a few other videos about how other people talk about this. Okay, and obviously Maybach, I just by mistake left it there. But yeah, so I was actually asking ChatGPT about certain things, and I'll try to explain you what you should do with ChatGPT. So the way we should look at things is like this. Let's say, for example, you have a portfolio which gives you a 62% CAGR. Actually, this CAGR is slightly different. Let's look at the last year for this strategy. So this strategy is a mixture of, again, as I said, five strategies, right? And I'll tell you the way you should design strategies and the way you should design a portfolio. If you want to make a holistic portfolio, yeah. So before till this thing is running, let's go on to that. So strategies have something like this, and this is the most general way of it. Like I would put it up. Any strategy, okay, it can have either. So these two things like run parallelly. So if it has a high gain and a low loss, it's generally a low probability trade. This is how the world of trading in options is skewed. Okay. So if it has a high gain, low loss, the probability is generally much lower. So anything under 50% is where I would put it. Okay. Or somewhere around 50-55%. Anything which is 50-55% has a good gain. So good RR, it if it has good RR, and its probability is low, like 50-55%, it would still win. A 2:1 RR generally just works. Okay, a 3:1 RR is going to be crazy. Okay, because if you can achieve something like this and over a longer period of time, um probably like 5-6 years plus, and it's positive, good to go. Okay, it doesn't need to be like extremely positive every year. It doesn't need to be um you know um like linear every year. It can be slightly here and there every year, like थोड़ा ऊपर नीचे चलता है, but you should still have some sort of consistency. You would want one strategy to be like this. So if let's say you have like, you should be probably 20% for a strategy like this, because look at it, it has a 50% probability. As soon as you have a 50% probability of winning, you start getting fucked once. Like, let's say for example, if you get three losses in a row, you're gonna have like a pretty bad night, because again it has a 50% probability. So the drawdowns are generally longer. Okay, so you don't want to do this with entire capital. You want to do this probably with something under 20%. Okay, the next strategy that want to come in is probably your banger strategy. The way I look at that strategy is anything in the ranges of um 55, or let's say 60% to 70% win rate, has a high win and a high loss. Generally 1:1 RR. Okay. And if you can find something around these lines, obviously this can be 1.2:1 RR. This can be like something close to you know, wow, I have no idea how to play with this, but yeah. So you can then generally, um like do it, like, you play with it. Okay, that is 60 to 70% win rate. I mean, yeah, win rate, and 1:1 RR works. The next I would look at is your bread and butter. Okay, so your bread and butter, this is something where you would require 70% plus. Okay, and generally the RR is going to be 1:2. So 2 for loss, okay, and 1 for win. Okay, and the way to achieve something like this, so bread and butter strategies should be replicatable. Okay, so the way, let's do one thing. Let's clear the screen. I think it's like start over. Yeah. So okay, let's just say, for example, with the bread and butter one, you want something which you can enter in tranches. Okay, generally, sorry for the handwriting. I mean, I should just probably do where you can enter in tranches. Okay, this can be in US. It's like, you have MEIC. Okay, you have spreads that you can enter, keep entering. Okay, generally these strategies have high capital requirement, because obviously these are bread butter strategies. In India, you have straddles, right? You do straddles and strangles all long day, and you put them stop loss on it. So those kind of strategies generally have, um, you know, high are MEIC spread, that means multiple entry iron condors, basically, which is straddle strangles, multiple entry, and they're basically spreads, or you can do spreads. So you can do one-sided spreads or MEICs, but you cannot make them your entire portfolio, and I'll explain you why. The problem with these strategies are you will never make uh, good money. So what happens is, if you never make good money, um, if you ever hit, if there is ever, so for example, what I'm trying to say is, um, let's say, let's just say, look at this like this. Okay, these strategies have a high margin requirement. So in India, you generally have 2 to 3 lakh rupees per lot without hedges, and you can see somewhere close to 1 to 1.5 lakhs with hedges, right? Yeah, I actually have a phone in front of me, so I can't really see the screen properly. But yeah, 1 to 1.5 lakhs. That's what you basically have, and in India, and in US, you have somewhere close to $5,000 to $10,000 per trade, because you wanna have a 0.05 spread. Okay, so like your hedge should be pretty low, right? In US. Okay, so because of that, you have a $5,000 to $10,000 per lot. So if you want to do like 5 lots, it's gonna be like 25 to, let's just say, few spreads are in this between, so 25 to $40,000 to even run like just 5 lots, and these 5 lots are not gonna make you much. Okay, so they're gonna probably make you like 10 to 15% a year. Okay, on that. Plus, you cannot run this entire thing. So the reason behind that is these have a high um a high var. So what is var, you might ask? You can watch videos like this. You can also ask ChatGPT what var is. So basically var is maximum risk possible. So max risk possible is basically var. What happens is, let's say if there is a black swan event, okay, a black swan event, or I don't know why I'm writing everything down, but let's say if there is some black swan event where market crashes like 10% in a second, or like, some sort of event, which, these kind of events are not impossible. They are possible. They are gonna happen. It's not more about if, but it's more about when, right? They'll happen one day. You want to be ready for that one day. So this allocation, you know, this kind of allocation, something around like this, should be less than 30%. So that, let's say if a circuit's hit at any given moment, you're not losing more than 30% of your portfolio. Now in US, because you don't have to keep your entire capital, you can keep around something around this capital, but then you also have to keep some backup capital, and you also have to withdraw money, withdraw profits. It's very important. Withdrawing profits become like the most important thing in something like this. Okay. So again, I'll go through this. The way it works is, what you want to do is basically, um, let me look at it like this. So let's just say, for example, okay, you want to have approximately, ideal cases, 15 to 20% um, into when you're starting out, especially when you're starting out, when you don't have any profit margin, into your um, bucket where you're running that you can say MEIC, okay, which is like multiple island condos, which have high risk. And this can be anything. You can be putting up spreads, okay, you can be putting up spreads, and that is also high risk, okay. In terms of your max loss, so your DD is gonna be pretty low on these. Like, DD is generally very low on these, because again, you're working around with stop losses and like general basic things. Like in Indian market, the way you sell straddles, and you put 30% stop loss, 50% stop loss, 80% stop loss, these are those kind of strategies, right? They generally have a low drawdown, they have a low return, okay, but they have a very high VAR. So VAR is very high because you have open hedges. Your basically your entire edge comes from taking that VAR risk. The reason why the market pays you is because of that volatility risk, right? So your stop losses, even though you have them, can get cancelled out sometime when there is an insane amount of volatility at like, well, a market just swings super hard in a very short time. That time your market stops are gonna just cancel, and you're not gonna have anything. You're gonna lose everything. Okay, but you need these strategies because you never know when this is gonna happen, right? It can take 10 years, and what you can do is you can lose all the gain. And I mean, you can, if you just always afraid of this, you know, you will lose out the gain on like in the 10 years, right? If it happens after 10 years, you're fucked because you lost all the gains that happened in the 10 years. And this is definitely something that if you were there in any of the COVID events, you would have got royally fucked, right? COVID events are quite normal. Like, obviously, I think the COVID issue was overnight. The COVID thing happened overnight, but it something like that, something similar to that can happen intraday. Like, for example, if you are trading your country options, and suddenly there is some sort of restriction in terms of some sort of tariffs or something like that by Donald Trump, right? Randomly, you can get absolutely fucked on your puts. Okay, so yeah, that can happen. Or some news in some country with something, and the SPX options can just violently move intraday. So it can definitely happen, right? So this is definitely something that can happen. So the way you should use these MEIC strategies are as fillers, or like I like to use them as fillers. Okay, fillers, or I would say like more like something around the line of um as to decrease drawdown, or like to smoothen out your curve, right? So if you have a curve, like generally this is something that would smoothen it out, okay, and it will give you like a, you would probably not increase too much on your returns, but you'll smoothen out your curve. So yeah, so these are the returns for the last year. You can see that last year was extremely volatile because we are looking at a very smaller um, time frame, and you had a max drawdown of 9%. Right. So the way we work around is I have given it, um, I gave it my I gave it my portfolio thing. Okay, the portfolio 17, so the older one, right? I gave it that, and you can see that I've done all sorts of different things. So, for example, I've looked at the standard deviation. You can ask it questions to Chat GPT on what the standard deviation of your portfolio is, वगैरह वगैरह. So I gave it the portfolio. I downloaded it from here, like the daily log, Basically, this is only something to do with the PNL. It has nothing to do with strategy. We're not looking at the strategy. We're only looking at PNL. And then, I asked it what's my Sharp and calculate standard deviation. And what it did basically is, all sorts of different things like um, it calculated basically all the ratios. And at that end of the day, it also did a Monte Carlo simulation. So basically, what Monte Carlo simulation does, you better to watch a video about it. I might not be able to explain it, but it calculates. So using a PNL, it basically checks what happens if all your max loss days are skewed in the starting or are skewed in the end. So what this basically means is, what happens if your worst day. So what happens if you're unlucky, right? So it basically is a calculation of being unlucky. Okay, if you are unlucky and all the worst things happen to you in the start of the event, right, that which would also skew your strategy later down the line. So it would do those calculations, and you want to be more blue beyond this line, right? You want to be over this line, and like we want most of it to go over this line. A few of them can go under, that's fine, but we want most of them to be over. And you can also, so this var calculation is slightly wrong because again, the downloaded sheet does not have anything where it says capital utilization, right? It has no field with capital utilization. If it had a field with capital utilization, it would probably be easy. But I'll tell you, my max capital utilization is somewhere close to about $15,000 on the 100K, right? So I'm technically making $100,000 last year on $15,000. So I'm not, even if let's say I don't use the rest of the money, that's the kind of return that I'm actually making. So technically you can actually do it, but would I really do it? No. I'd probably keep the rest of the capital, and with every profit I would try to scale it. So that's the way to go generally. But yeah, so you can also ask ChatGPT certain things, like let's say for example there is a circuit or black swan event or a risk. How much time will it take for my portfolio to get back up? So with let's say a 10% drawdown, what would happen? A 20% drawdown, what would happen? So these kind of ratios would help you understand what the actual risk is. Because look, the perceived risk for something like this is actually 15 to 20%. That's your drawdown, right? Sorry, that's not your drawdown. My drawdown is 9%, but a perceived actual risk on your portfolio is something close to 15-20%. So if you're making 100% a year, that means you're somewhere close to doing a few months, you're actually doing like 10-20% returns. Those 10-20% returns are actually more than your value at risk. This is the way to skew your strategies. If you skew your strategies in such a way that you're making a lot more and your VAR, you know, your VAR can mitigate it in 1 to 2 good months, that's where I believe you are in a sweet spot. Okay, this is how I would generally try to, you know, design my strategy. Okay, so we also talk. One more thing that I want to add in, the way you should ratio your strategies is something like this. For every one risk of your um, high risk, like so we talked about, like, there was three strategies, right? 50-50, 50-50 probability, okay, and then around 60 to 70% probability, and then we want like 70% plus. Generally this can be 80% plus. So the way you should actually do this is, let's say for example you're taking total risk, okay? So we'll define var risk differently, okay? So let's say for this one, your var risk, okay, I'll write it over here so that this is more clearly visible to me. I have a camera in front of me, right? A phone in front of me. So 50-50 risk, you want to take the lowest amount of risk, because again, your the ratio of profit is higher. So let's say every day you should take a max $1,000 risk on this for 100K. That's max 1%. Okay, so a max $1,000 risk, and that's what I was trying to say. The reason why I have more than $15,000 capital, even though that's my max usage on my this thing, is because I have such a high drawdown, right? So my capital is definitely going to decrease. So I need like at least double, triple of my drawdown to be in the account, plus the capital, plus I also, there are other things that you need to maintain in the account. And what you can do with the rest of the capital is you can just buy either stocks like either S&P or like index, or you can also buy treasuries, right, which will give you like 2-3% extra every year. So yeah, so 1k, so $1,000 on this max risk on 100k account. I would take $1,000 on this. I'd probably take $2,000 on this to 2,500, but not more than that. And I would probably take a value pair of about 15 on this. So this would be a good ratio to maintain. And then there will be one more ratio. Once you get profitable, you want to run into these multiples, okay? You want to be in somewhere around this multiples, okay? Multiples of this, okay? And then there's one more, that is overnight risk. You want to definitely take out of 30% of your intraday profit. This is a slightly tricky thing, but generally the way generally the way overnight risk is perceived or overnight risk is distributed is much different from intraday. Okay, the reason behind that also I'll explain you. I should probably make a separate video about overnight risk, but let's just look at it from a standpoint of this. Okay, let's say you take one trade every day. So every day, okay, every day I'm gonna come in and take one trade. So at the end of the year, let's say I take 200 whatever something 200 plus trades. Okay, let's say I take let's say there is a selective strategy. So there is a selective strategy. In a selective strategy, let's say my triggers are not triggered every day. So I will take, let's say it is triggered about 40% of the time. So 80 trades. Okay. So my turnaround time, right, in a year is 80 times. I get 80 data points. Okay. And on in an everyday trade, I get 200 data point, right, every year. But when it comes down to an overnight trade, okay, if you're taking an overnight trade that is 1 week long, um, how many weeks in a year? Let's just go by that. I have no idea how many weeks in a year. Yeah, sorry. Oh yeah, it was 52. My bad. So, yeah, 52 weeks in a year, right? So you get 52 trades. Okay. And out of these 52 trades, let's say you had a selective entry, you'll probably get like a 40% entry, or let's say even if you get like a 60% entry, a max you're getting 40 entries if you had selective entry. Okay, generally you want to have selective entry, generally you want to have this, and you also want to have like something which runs every 2 to 3 days, so that you can let me put it up with using a chart. So I'll explain it using chart. I will make a separate video on how to price overnight risk, but let's just look at this. So if you're getting such lower, um, entries and like such low data points, backtesting a strategy becomes different because market changes a lot over time. And your cycle for an intraday strategy, let's say a cycle for an intraday strategy is 3 years. Okay, so you're doing 200, 200, 200. So you have 600 data points plus you're doing per day, let's say 3 entries to 4 entries. Okay, that means you have like 600 to 800 data points per day on some of these strategies. Selective strategy, let's say you're only entering once, so you have, let's say, 80 data points. This is much lower than 600, 800. But think about it, how good of your back testing is gonna be for your everyday strategies compared to like only 40 selective days across a year, right? This is a huge drastic difference. So that's why you don't have that kind of data set to understand. If let's say you do multiple strategies, obviously your risk is much different. And plus, in overnight strategy, the problem is all your risk is skewed. Okay, so no matter what you do, no matter what spread you make, right, if you make a like an iron fly or iron condor, overnight iron condor, no matter how you put it up, if market's gonna go down, you gonna lose on it. If market's gonna go up, you gonna lose on it. Like obviously you can make some changes to it, but more or less what I'm trying to say is everything is going to be skewed, and everything is going to be skewed with overnight volatility, right? And overnight volatility is not zigzag. Okay, like in intraday market goes up, market goes down, you get your stop losses cut, and then it comes back in whatever loop. But in overnight, it's either opens green in the morning or red in the morning. I'll try to make a proper video on it later down the line, but I'll explain how risk is generally skewed on overnight, and overnight has to be dealt differently from intraday. But again, I would never take more than 3% fair risk overnight, and that has to come from profits. Never risk anything on overnight with your initial base capital. That's just not generally preferred. You can do it on smaller accounts because smaller accounts can be grown faster with overnight risk, but it's just not worth it. For most people, it's not worth it. For smaller accounts, people want to take a lower risk, probably, yeah, because on weekly trades, you can probably take like $1,000 risk on one trade, which is spread across a week. So you are taking like $1,000 risk per week. So you know what your risk per week is, and just taking one trade. So it's like much more easier. But look at this, right? Let's say you started a strangle. Let's say you started an iron condor here, and the iron condor was, you started an iron condor which was like, let's say 15, 25 days apart. Okay, 15 Jan. You actually would get a pretty decent profit after 25, uh, up around 25 Jan. I'm just giving a random example. But in the middle, you would have seen quite decent loss, like just around like next 1 week. Okay, your calls would have absolutely been brutally fucked, right? You might have even hit your max loss over here, but then it settled down, right? So anything can generally happen overnight. It is just that you need like multiple strategies that can capture all the movements across the days. So you need something which is 2 days, 1 days, 3 days, 4 days, 5 days, 6 days, and you will need to like do it like 10 days, then 15, then 30, then 40. So capturing overnight risk and capturing overnight volatility is like a thing that probably only higher capital, like you can only do it with high capital, and you can only do it with much better risk managed risk. So that's something that we can make another video on like later down the line. But yeah, I mean, if this video was like, helpful, I have been talking for 27 minutes. Um, but yeah, I mean, if this video was helpful, good. Otherwise, bye. Anyways, bye bye. See you guys later.